When you open a fixed deposit with the bank and you see that the rate offered to you by the bank for a period of 3 years is almost 8%, you are jumping with joy. You think that it's really nice, it's really good. Also, because fixed deposits are a safe investment, you tend to get overexcited about it. And then when you see the headline inflation numbers, you find that the inflation is almost 6%, and this is not looking good for your returns. Hello everybody, welcome to my YouTube channel. I'm your learning partner Sushila Hariharan, and I talk about everything regarding global markets, especially equities, bonds and currencies. So how does this work? What happens to your returns when it is eaten away by inflation? Let's talk about the concept of real returns and nominal returns. Whenever we go to open a fixed deposit or invest in a bond or in a debenture like product, we are often assured returns, fixed returns. This fixed returns is a percentage rate that is given to you as a part of your returns because you've invested in that fixed income security. So fixed income security gives you coupons, fixed deposits give you interest, and you may have any other kind of terms that you would like to have, but ultimately it's a compensation for your savings, it's a compensation for the sacrifices that you've made, and therefore interest is paid for your capital. Otherwise, as an investor, you would choose to spend it at the mall or at a disco or anywhere else, but instead you've chosen to sacrifice those kind of spendings and put it into an investment. And why you have chosen a fixed income investment is because you want to have the safety of that principal amount. You don't want to be subject to market risk. You don't want your investment subject to market risk. You want to get your interest on regular basis. You want to get your principal at the end of the maturity, etc., etc. So therefore you've invested in fixed returns, fixed income products. This is the interest that is called as the cost of capital for the issuer, the returns for the investor. The investor is compensated because they've made a sacrifice. They've released their savings into the system, and for that they demand a compensation, and that compensation is interest rates. As long as you read the interest rates that are published on the rate card of the bank or on the bond instrument, these are called as the nominal interest rate. A nominal interest rate is a interest rate that is paid as a percentage of the par value to the investor, or as a percentage of the principal amount to the investor. This does not take into consideration the very strong and sometimes negative impact of inflation. So the headline interest rates that you see everywhere is the nominal interest rate. But what happens when inflation starts creeping towards unhealthy highs? Okay, so when inflation is increasing, so what is inflation? Inflation is the prices are increasing. When price increases happens regularly at frequent intervals, when your Lays and Maggie start costing you more, it pinches you more when you're a bachelor on your monthly budgets, then you say that there is an inflation. Okay, so inflation has a trickle down impact. For example, inflation is high, so the petrol prices are high, transport cost increases, you pay higher cost not just for your own expenses, but you're also factoring all those increases that have taken place in those expenses. So inflation, as it increases beyond manageable levels, it is eating away into your returns. What do I mean by eating away into your returns? As interest rates on fixed deposits are increasing, for example, you get jubilant, you get very happy, you get very excited, saying that wow, I'm going to really make that kind of money, which looks to be satisfactory to you, especially if you come from a risk averse background. If you come from a risk averse or a risk conservative background, you will want to invest in products that are giving you fixed returns. But when inflation creeps into the system, it starts eating away into those returns. And if you are an individual who is dependent on that income for managing your day-to-day budgets, then you will find that over a period of time, you need to pay more for the same goods. Yeah, so the net impact of inflation on that interest rate is very, very significant. Look, we all know that inflation is high, right? And we all know that inflation exists. So inflation is there, is a known, it's a given. But what I'm trying to say over here is that if inflation eats away into those returns, sometimes you can have inflation higher than your nominal interest rate in some countries, especially of South America. For almost all of 2022, 2023, inflation was galloping away, and interest rates provided on fixed deposits by the banks was significantly lower. Investors said, why should I save? There is no need for me to save. I might as well spend it because the returns to me are negative. Yeah? So when inflation starts galloping away and it starts running away very fast, very quickly, very sudden, it eats away into the returns for the investors. Investors who depend on this income given by nominal interest rates suddenly find that the nominal interest rates are not enough. And when nominal interest rates are eaten away by inflation, it results into the end product we called as real interest rates. Real interest rates have to be kept under control. Sometimes during some phases, real interest rates could even be negative, right? We saw for many, many years in some countries, interest rates were so insignificant, the returns were so insignificant because of inflation and hyperinflation that investors chose not to save, not because they didn't want to save, but they just couldn't save because all the money that they were earning was just being used for spending, right? So the important aspect of keeping inflation under control is not just a trickle down impact on nominal and real interest rates, but at the end of the day, the investing philosophy of the citizens of a country. And hence inflation has to be under a defined bandwidth, a defined range, which the monetary policy experts of every country will clearly state that they're comfortable with this. If it goes above that level, then investors who have invested significantly in fixed income products will stop investing in fixed income products because they will find that the real returns are significantly lower than the nominal returns that have been put in. When interest rates are very high, the cost of borrowings for many of the manufacturers and producers also increases, and they may not be able to maintain their cost competitiveness in a largely global economy. And finally, retail investors, especially senior citizens who have been putting in their money into the fixed deposits for longer maturities in a hope that these fixed returns will take care of their retirement lifestyle, will find that they're not able to do so because hyperinflation or very quick, fast moving inflation has eaten away into the returns. So whenever you're looking at interest rates, when you're discussing interest rates and when you're evaluating, is the interest rate a significant impact on your income streams, or is the interest rate a significant return for you, then you must consider this aspect of what is the inflation as well in the country. If inflation is high, it is eating away into the nominal returns, nominal interest rate, and the end product that is called as real interest rate is now significantly lower. And we must not allow that to happen, because when that happens, the country's economy will tend to go into a tailspin because the cost of borrowing then becomes remarkably high. All this, there are real cases that have in countries where these have happened, where the real interest rate has been literally zero because the inflation had eaten away into almost all of the nominal interest rate. So there are countries, there are cases, so many through decades, through 1990s, even in the last decade, where countries have not been able to manage the situation, and hence we find that real interest rates have to be significant, they have to be meaningful, and they can be meaningful only if inflation, the big daddy of costs, is kept under control.